The Totalitarian Two-Step by Dennis C. Jantzen, as read by Bonny Jantzen. Chapter 7. Zombie Apocalypse. Try as we might to postpone them, days of reckoning inevitably arrive. Brandon Mull. Zombie company is a name used to define a non-competitive business that needs a bailout to operate, or an indebted firm that can only repay interest on its debt. These companies generate just enough cash flow to pay the debt's interest and cannot reduce the actual principal amount. Therefore, firms do not have reserve funding. Capacity is stagnant, which means they are too frail to invest or grow, and along with the USI empire, eventually die. They were once America's business titans, beloved household names, case studies in business. But nowadays, they are progressively appearing like something different, zombies. And their numbers are increasing. Boeing, Carnival, Delta Airlines, Exxon Mobil, and Macy's. Many of the nation's most iconic companies are not earning enough to cover their interest expenses. The total amount of zombie firms' debt now exceeds $2 trillion. Zombie companies get their nickname because they tend to limp along, unable to earn enough to dig out from under their debt, but still with sufficient access to credit to roll over their debts. Zombies drag on the economy because they keep assets tied up in companies that cannot afford to invest and build their businesses. An analysis conducted by Bloomberg Financial looked at the trailing 12-month operating income of firms in the Russell 3000 index relative to their interest expenses over the identical period. The results paint a grim outlook. Nearly a quarter of the index, or 739 companies, have not earned enough to meet their interest payments. That compares with 513 firms at the end of last year. The $1.98 trillion they collectively now owe dwarfs the $1.05 trillion of debt zombie firms reported before the 2020 pandemic laid waste to balance sheets. The Boeing company requested $60 billion from the U.S. government to help them cope with the airline industry's downturn during the pandemic. However, over the prior 10 years, the company had already received $58 billion in free money, all of which was used to buy back its shares, $43 billion, or give shareholder returns, $17 billion. The Bank for International Settlements estimates that zombie companies now account for 16% of all publicly traded U.S. companies and more than 10% in Europe. Yet, over the last decade, anemic profit rates have meant that most of the currency sloshing around the system has been used to inflate asset values, or create what Karl Marx defined as fictitious capital. The fake money has been used to keep zombie companies afloat. The Federal Reserve is propping up these zombies by purchasing corporate debt in the form of corporate bond purchases and exchange-traded funds, ETFs. In 2020, the Federal Reserve's corporate bonds portfolio and ETFs rose to $14 billion, with only plans to accelerate purchases. The Federal Reserve's end goal is to be the buyer of last resort of nearly all publicly traded instruments and control nearly all elements of the economy. When the zombies finally die, the private bank, in conjunction with the U.S. government, will pick away like a vulture on the corpse of a dead buffalo, utilizing the vitals while letting the guts rot away. Part of the rotted waste will be the insolvent pension funds. They are accomplishing their mission, and it did not cost them any money to acquire these assets because they used currency that they created digitally using a computer keyboard. Yet, if the common folk tried to create currency, they would be prosecuted with counterfeiting. There are two rules of laws, and the justice scales are far from balanced in the USI. Continuing, as displayed in the following chart, the Fed now owns more Treasury notes and bonds than ever before. The Fed pays for this buying binge using debt monetization. A country monetizes its debt when it converts debt to cash or credit. The only way a country can do this is through its central bank, which can purchase the government debt and replace it with credit. In turn, the central bank puts the debt on its balance sheet. It monetizes U.S. debt when it buys U.S. Treasury bills, bonds, and notes from member banks. The Fed does not have to print currency to do so. Instead, it issues a credit to the bank's account. This credit is treated like currency, even though the Fed does not print the actual cash. This process is called open market operations. All this purchasing happens using funny money, which is created out of thin air, as explained before. It gets crazier. The Fed lent the currency used to back these security assets, such as the Treasury bills that the U.S. Treasury Department created, which they eventually buy back because there is no demand for the debt. To summarize, the Federal Reserve is purchasing its debt because there are no buyers. The circle of dysfunction started back in November 2008 during the Great Recession, when the Fed began purchasing mortgage-backed securities. Currently, the Fed owns approximately 1/3 of the mortgages. According to the J.P. Morgan analysts, if the Fed maintains its current buying pace, it will possess 34% of the mortgage universe by the end of 2021. Recently, the private Fed bank decided not to update their mortgage debt amount and keep the increasing amount a secret. Time reveals all secrets, and soon the lifting of the veil will expose the vampires that have been sucking the blood from the purchasing power of the U.S. dollar since 1913.